Hi, I'm Kep Kepner, CPA here in Dallas. We're talking about some year-end strategies that you can use for your business. One possibility is to consider paying yourself a dividend because the tax cost of a dividend might be less than taking more salary and paying the tax on your salary. Why is that? Well, salary is subject to Social Security and Medicare tax as well as income tax. If you're a regular corporation and you have a profit, and let's say you're at the low tax bracket, okay, so you might decide to pay a dividend to your owner, which would be you, the business owner. In that case, the company cannot deduct that dividend as an expense, but their profit is in the 15% tax bracket. If you're sitting here in a higher tax bracket, then you can take that money, and even though you have to pay tax on it, you don't have to pay Social Security and Medicare on it. So it's possible that taking a dividend is a better tax efficient strategy than taking more salary and deducting it in your C Corp. So this doesn't work for an S Corp or an LLC, but it is a strategy for a C Corp. What about those college kids that you've sent off to college? The American Tax Code in general says that education is a responsibility of the family. So people who are spending money to send their kids to college unfortunately do not get much in the way of tax breaks, but there are a couple. One of those is the 529 plan. If you put money in a 529 plan, you do not get a tax deduction when you put it in. So when you spend that money on tuition, books, fees, room and board, qualified educational expenses, then you get to take that money out of the 529 plan and not pay tax on it. Well, that sounds like you're just trading dollars, but the reality is if the value of the 125 plan grew, 129 plan, so so
529.
yeah, it's 529, right?
You said 129.
I know, okay. You said it twice wrong.
Okay.
So if you, don't forget this, if your 529 plan grew in value because the funds you put in were invested, all of that growth can come out tax-free if it's used to pay these qualified educational expenses. So that's one benefit. There's another one, the American Opportunity Credit, that's available to students, and it's $2,500. Now, if you make more than $160,000 as a married couple or $80,000 as a single person, then that goodie is not available to you any longer. So even where the U.S. tax code says it's up to you to pay for college, that doesn't mean that you can't get some benefit through the 529 plan or by taking the credits. So you should consider those options. I did learn about a very interesting idea. Now you tell me whether you think this works, and I'll tell you what I think. So I have a company. Let's take my company. I have a company, and we have office meetings from time to time. So what I want to do is I want to find out what it costs to rent a room at a hotel, and let's say for half a day it's $300. Then what I want to do is I want to have this meeting not at the hotel, but I want to have it at my house. And I want my company to pay me that $300 rental for renting my room at my house, which has all the facilities to have a really good office meeting. So the IRS code says that an individual can rent out their house or their garage or some of their property for up to 14 days and take that income in tax-free. They don't have to pay tax on it. So what do you think? Do you think that would work? Quite frankly, I think it would work until you were audited. And then if you were audited, the IRS would say, okay, the family attrition rules kick in. Kepner, that's your house, and so you're basically just taking money out of your company and giving it to you tax-free. So I don't think it would fly in the case of an audit. It would fly if you're not audited. So I don't know, do you want to take that kind of risk? That's one of those areas in the tax code where you can take a position and it's never a problem unless you're audited. So now, your CPA, myself, I might be concerned about that because there are preparer penalties, so I'm not going to advise you to go out and scam the IRS for sure, and I'm going to want you to document the things that you do. But the reality is, you can make that position and take it, and the reality is, you're probably not going to get audited. I have a client that for years bought baseball tickets, and with the idea was he would take his good clients to a baseball game. Well, when you entertain somebody, you have to go with them. You can't just give them the tickets. So if you give them the tickets, it becomes a gift, and those gifts are limited. If you take them to the game, then it's entertainment, and it's only 50% deductible. This client decided to stop buying those tickets because the team wasn't doing too well. And as a fact of the matter is, he said the price went up and the fun went down, so he stopped doing it. But the reality is, he bought tickets for many years, and he was never audited, so he was able to deduct all that. He didn't have records about whether he gave those tickets to his customers or whether he went with them to the game. If he had those documents, then he could withstand an audit because he would have been entertaining a customer. They would have had a business meeting prior to the game or that afternoon, and that makes it allowable deductible expense. So there are all kinds of things about the tax law that you might take a chance on because the odds of getting audited are less than 1%. But I'm not going to guarantee that you're not going to get audited because the IRS chooses who they want to audit. I will tell you, if your tax return passes the smell test, if it doesn't pass the smell test, then you've raised your odds of being audited. So I can advise you about that. If you need any help, give us a call. Thanks.